Hello, everyone. Today we're going to be starting off with a presentation by us four, and then we're going to go into having a panel discussion followed by a Q&A with the panel. So just to introduce ourselves, my name is Devin Hirsch.
My name's Aaron Ahmed. I'm Eric Yeh.
And I'm Marwan Bahiri.
And today we're going to be talking about an ESG premium. Over the past few years, ESG investing has taken the world by storm, and sustainable fund flow has followed that effect. Now, this surge in demand must have had an impact on equity markets. And that's what we wanted to study. What was that impact? So let's get into it. Today, we're going to start by introducing ESG, talk about its connection to short-termism. After that, talk about the evolution of ESG investing, talk about our study, analyze our results, and conclude from there. So let's start off with ESG. What is ESG? If I have to sum it up in 3 words, probably be environmental, social governance. But more specifically than that, it's all about mitigating risk and the maximization of opportunity. Let's take a look at an example. Human rights, workers' conditions. Those are a reputational risk for many companies. Companies that treat their workers poorly may deter customers from buying their products, their goods, or services, hurting revenue in the long run. On the side of opportunities, let's look at renewable energy. Investing in renewables may be costly now, but over the long term, it can provide cost savings for so many industries. But that's what ESG is, an investment in the future. And this has posed problems and conflict for so many CFOs, because while they want to invest in the future, CFOs and finance professionals are feeling the pressure to reach and meet quarterly earnings targets. And these quarterly earning targets are something extremely pressing for all of them. And a PwC study found that 90% of finance professionals are cutting or pausing funding for long-term projects to meet their bottom line targets, which can be extremely damaging for many companies in the future, because R&D, or in this case ESG, is inherently tied to future performance. And now I'll give it off to Aaron to talk about sustainable fund.
Thank you, Devin. So, as was alluded to in the introduction, there's been a surge in demand and popularity for ESG-related investments. This has to do in large part because investors realize that when companies do well in ESG, they serve to protect their long-term risk mitigation and allows them to maximize opportunities. Perhaps this is most evident where we see ESG and sustainable fund flows. Just in the last quarter of 2024, we saw $9.2 billion of inflow. This has led total global sustainable fund asset value to hike up to $3.2 trillion, an all-time high. We also see this demand at the individual level as well. 89% of investors factor in ESG metrics and performance when making their buying and selling decisions. This has then created the need for companies who are now expected to spend over $2 billion annually on just gathering the ESG metrics to provide to those investors. But now, with all these investors wanting this information and this data, here comes the need for frameworks to make sense of it. Investors want to be able to compare apples to apples. They want standardized metrics to compare companies against one another. Thus, the prevalence of frameworks such as KLD, MSCI ESG, and SASB have emerged to help investors make their decisions using standardized metrics. So, with all of this new conversations emerging around ESG, one topic that has come up is the idea of an ESG premium. What does this mean? In simple terms, it's the idea that firms that do better in ESG performance will have higher share price valuations. Now, we see this in the bond market as sustainable bonds between 2021 and 2023 on average had an option adjusted spread between 1 and 6 basis points higher than their non-sustainable counterparts. But in the equities market, we don't see any clear-cut evidence or labels to try and pin a phenomenon like this. So that's what our team was trying to accomplish with our research. We wanted to look to see if we can find a way to pin down an equity premium. We hypothesized that we would find one and that companies that did perform better in ESG would have higher share prices. And this was because of, like I mentioned earlier, that ESG helps risk mitigate in the long term. So there have been many studies in this field, and a lot of them have shown positive light on a potential ESG premium. However, none can say anything definitively. One in particular I'd like to highlight is the one on the left by Flammer and Bonsall, and they studied proposals relating to ESG and whether or not they were passed or failed by a certain firm. And they found that when ESG proposals were approved, there was an immediate short-term spike in stock valuation. Now, the problem with this is that there's no statistical meaningful difference between a proposal that passes with 50.1% of the vote or fails with 49.9. And so more work needs to be done. So we tried to take a stab at it ourselves. And to talk about our methodology, I'd like to pass it off to Eric.
Thank you, Aaron. So, yes, as Aaron concluded, the current ESG frameworks, they're good, but they lack quantification. So what we did instead was we built a rubric by ourselves and categorized all our companies into four categories, which is present, future, strengths, and concerns. So now by merging them together, we now categorize our companies two by two each. So either companies focusing on present and has a strength, or focusing on present and has a concern. So now we are also comparing apple to apples. So after we built our rubric, we then merged our rubric with the existing financial performance data set. And now we have a new comprehensive one, which we can build our analysis on with like both financial performance and ESG performance. So yeah, by doing this work is hard, but by doing that, this allows us to like directly analyze based on all the information to determine if there exists a relationship. So we then run regression analysis using data to determine the relationship, and we have our results next table. Yep, so here's our results, and we'll focus on the leftmost table here with the green row. So as you can see with the green row, companies both among firms or within the firm themselves, companies who focus on present and has a strength show a negative relationship between future returns and this focus. So you may wonder what this tells us. I want you to think about two companies who has the same level of future return, but one with the initial lower initial price and the other one with a higher initial price. So which one do you think will require a lower return rate to achieve the same level of future return? The one with a higher price in the beginning. So this also indicates us that companies focusing on present and has a strength is also likely to have a price higher than this peers who does not. So and compared to companies with focusing on future and has a strength, that shows a much stronger relationships. These three asterisks here show statistical significance, which indicates how strong this relationship is. Now, something interesting to bring up though is that within companies themselves, companies that has focused on present but has a concern is also associated with a decrease in return. And we're also considering other variables such as ROA that may also contribute to this relationship. But for implications of the results, I'll pass it on to Marwan.
Thank you so much, Aaron. So now just moving on to our final findings. So I'm gonna really ignore the numbers that you see on the far right because I know that none of you guys are gonna understand what they mean. But what we did find was potential evidence of an ESG premium existing for both current and future initiatives. Now, what does this mean? Essentially, investors are willing to sacrifice short-term returns for companies that focus on long-term ESG initiatives, thus the existence of a premium. And then on the flip side, companies that have no focus on ESG whatsoever, investors are also willing to put their money into that simply because they're focused on those present strengths. Now, when running the regressions, what we did also find was the fact that there's an inverse relationship between companies that have long-term ESG focus and returns, thus the potential ideology of a premium existing. Now, there's two things that I really want to note here. One is our limitations and one is the potential for future research. When analyzing the data, most of our variables were not weighted equally. what this means is because there was so much data, obviously when categorizing it, there were different weights for each pieces of data. And as a result, we had what was known as an unbalanced panel, where essentially our data was not fully complete and not fully realized. In addition to that, what the problem was ESG initiatives also fall under R&D within a company's financial statements. And so as a result, we had to filter out those R&D investments, but that also opens up opportunity for future research, which we plan to do now towards our final paper. Thank you so much.
Okay, so now we're gonna segue into our panel discussion. So if our three amazing panelists can come to the front and we'll get started. First and foremost, thank you all for being here. I'm going to start by introducing the three panelists here today, and then from there, we're going to ask a few questions. After that, we'll have a open Q&A from the audience. So we'll go from the left to the right. We'll start with Estelle Sun. Estelle Sun is an associate professor of accounting at Boston University's Questrom School of Business. She earned her PhD and MS in business administration from the University of California, Berkeley, and holds a Bachelor of Commerce in accounting with first-class honors from the University of Otago, New Zealand. Her research explores corporate social responsibility, earnings management, accounting conservatism, financial disclosure, and the use of financial information for investors. Her work is published in leading journals, including Contemporary Accounting Research, Journal of Accounting and Economics, and Management Science. She is particularly noted for her research on ESG-related disclosure and the financial implications of climate risks. Florian Berg, center, is a principal research scientist at MIT Sloan and co-founder of the Aggregate Confusion Project, which explores inconsistencies in ESG ratings and their impact on markets and research. His award-winning work has been featured in top journals and global media, including the Wall Street Journal, Financial Times. Florian holds a PhD in economics from Paris Dauphine University and has prior experience at ETH Zurich, Amundi Asset Management, and Alphadyne Asset Management. And lastly, but not least, Robert Fernandez. Robert Fernandez leads sustainable investing and engagement at Breckenridge Capital Advisors, where he has been since 2010. With over 26 years of experience in research and credit analysis, he previously held roles at Opus Investment Management, State Street Bank, and other institutions. Rob holds a BS from Boston College, an MBA from Boston University, and a master's in sustainability from Harvard. He is a CFA charter holder and FSA credential holder and serves on several nonprofit boards and industry committees, including the CFA Institute's ESG Technical Committee. So I'm going to start by asking directed questions. Of course, the rest of the panelists, feel free to chime in and add, have a fluid discussion. But after that, we are going to have some questions that are open to all three of you guys. So we'll start with Estelle. So your work highlights how investors respond to specific ESG disclosures, particularly environmental ones. In your view, do disclosures around forward-looking ESG initiatives like long-term emissions targets move the market differently than disclosures about past performance? Yes, sure.
All right, I guess I can get started. So hi everyone, my name is Estelle. Super excited to be here and thank you very much for having me. So I guess I can just answer the question. So the paper Devin referred to was one of my prior work. I look at the value relevance of greenhouse gas emission. So in that paper, during our sample period, greenhouse gas emission was mostly voluntary. So what we found in that paper was that for companies that voluntarily disclose greenhouse gas emission, their stock price was significantly lower compared to similar firms that disclosed their greenhouse gas emission, but their level was much lower. So another way for you to think about this is that it seems that investors kind of view greenhouse gas emission as an off-balance sheet liability, so like a future obligations to the firm. So that was what the paper was about. And then back to the question about backward information, forward look information, I think in the ESG space, those two concepts are not as clear cut as we can imagine here. So take greenhouse gas emission as one example. We know that's a backward information, right? Technically, because it reflects the past transactions occurred to the firm. However, if you imagine a company with a very high greenhouse gas emission level, that may also indicate an increased future cost in terms of regulation, compliance, reputation of the firm. So in that sense, a technical backward looking information like greenhouse gas emission could be a forward looking measure as well. So I think there's a forward looking component in that. And then in terms of the question, does the market actually price the forward-looking information like the greenhouse gas target, net zero goals? I haven't seen any papers that actually answer that question. Potentially, that can be a very important empirical question. To me, my gut says that it depends on what's the news in that. If there's any unexpected news in the disclosure made by the firm, right? I can imagine for companies that have been really proactive in reducing greenhouse gas emission, additional disclosure like I'm going to meet my target may not be as surprise compared to other firms. So for those companies, those information may already be priced in. Whereas for other companies, if the disclosure, signals a real shift, then potentially you can have a valuation impact. It depends on a lot of things. It kind of depends on how credible the signal is as well. We talk about it in class. If your greenhouse gas target, your goal is verify like SBTI, the science-based target, that may carry more weight, then in that case, it may move the market. Okay.
Yes, I think I have. Hoping my mic is working. But that's very tough growth. They can't hear. How about? Yeah, that works. Okay. May have to switch it, but okay. Do that. Okay, next question. That's better. Okay. Okay. Good. Great. Thank you guys. So very thought provoking. Thank you for that. So now for Florian, question is, our paper uses like MSCI and KLD data to create this composite ESG profile. Given your work in ESG ratings divergence, how should researchers interpret contradictory ESG scores? Is it noise, or are they measuring fundamentally different things?
I think the answer is both. They're certainly measuring different things, but they also sometimes try to measure the same thing. There are several ways you can do. Here in this sort of academic setting, we actually tried a lot of ways of reducing noise in those ESG ratings methods that have been established also in the literature, in the academic literature. The easiest way you would actually think about this, if you have, let's say, 4 or 5 ESG raters, you could just create an average. Because we all learned that errors cancel each other out. But the problem with ESG ratings now is that they sort of still measure some different things, right? They try to get to this really ESG performance, whatever that is, right? Whatever they think it is. But they will come from a different angle. Some, as you mentioned, some will look more at opportunities, others a little bit more at risk. And then even there's a whole other set of ESG raters that will add impact as a layer, right? What is actually the impact of the company on the world? And so then that means statistically speaking, the errors that those ESG raters make, they will be different. And so then you can't really use an average anymore. Others, I mean, you probably heard that those who are a little bit more technical, they run then principal component analysis. When I used to work in finance as a quant, that was basically my job, running principal component analysis. And here you have a similar problem because it's also sort of weighted average. And so we actually use then an instrumental variable approach. And for those who a little bit know, it's very easy. You regress one rating on a couple of others, and then you keep actually the predicted value and you insert that in your regression. We actually saw that then the correlation between return and ESG performance went up by a factor of 2.6 on average. And we tried that for 8 different ESG raters. So there are certainly ways where how you can reduce noise. Yeah, that for sure. The other thing is that there is also certainly measurement noise in those ESG ratings. That there's no doubt. We don't even know often how to measure those constructs, ESG performance perfectly. And sometimes we will never be able to get there. Imagine if you really wanted to measure discrimination in a company, right? What would you need to do if you want to have the perfect measure? You would basically measure every interaction and non-interaction between everyone in the company inside during the working hours, but also outside the working hours. Because if you meet up with a colleague on Saturday night for a drink, then maybe you make some decisions that also will impact then the discrimination within the company, right? And that obviously has privacy problems. And that goes against another actually part of ESG, because that would be more in the G part, privacy concerns. So even if we could, we would probably never get to the perfect measurements of those ESG ratings. And so that's why we actually have to embrace the fact that we will most likely for forever measure a lot of those things imprecisely, but that doesn't mean that there's no signal in there. And I think the more I work in this field, the more I think that there is certainly some signal in those ESG ratings.
Very interesting to hear. Yeah, and I mean, when you hear the term ESG alone, like combining 3 things from 3 different pieces of the puzzle together to create a score, like that alone does create some noise, some confusion. So there's distilling that is very, very important. And now onto Robert. You've worked in the sustainable bond market, so this will give us a different perspective from our presentation. But in the sustainable bond markets, we've seen divergence of issuance across sectors. In your view, how can investors distinguish between genuine ESG value drivers and thematic label chasing when you evaluate sustainable bonds?
Yeah, it's a great question, and it's a real pleasure to be here. Maybe just said it quickly as for a little bit of background. Breckenridge Capital Advisors, we're based right here in Boston. We manage about 52 billion in assets or so. I've been there for about 15 years, which it's been a fun place to work. And we started integrating ESG considerations into our investment process, about 15 years ago, for 2 key reasons. One was we thought it just made sense to consider these factors in our investment and fundamental research, because we think, certainly as we're discussing, that they can impact long-term business value. And then also we integrated ESG and increasingly not calling it ESG and calling it sustainable. If you're hearing that trend, but we integrated these considerations really to stand apart from competition. And it really has worked out well by being kind of early to considering these factors in our research process. It helped us stand apart from competition. So to your question specifically, what we try to do is look at the underlying sustainability drivers of the companies that we're investing in, and make a conclusion to their performance and profile, so that if they go and issue a sustainable or a labeled bond, green, social, or sustainability bond, we're looking at the issuer's performance and profile. We're not just looking at the fact that they are, issuing a green bond for a particular project. And it might be really an important project that they're financing, but we want to make sure that that company is doing, thinking about the long term, looking to manage it themselves responsibly, and not just issuing a labeled bond as a label or to send a particular signal to the market. One point I wanted to mention, just as far as we've been investing in the green, social, and sustainability bond market since 2013. The market really got going, and it started in like 2008 with the World Bank, and then kind of was slow, and then kind of took off maybe 2014, 15, and has kept going. But in the last couple of years, I wanted to mention, you're probably aware in the US, because of ESG pushback or scrutiny, the number of labeled bonds that are being issued in the United States has really dropped. And, it's certainly unfortunate. We have been investing in those bonds for our sustainable clients, like I mentioned, for a long time, and our clients really like to see it. But I think, and we can probably talk about this more, that companies, I think in the political environment today, don't see it, that kind of bond issuance as being worth the risk. It can draw like unnecessary attention. So, globally, you're still seeing a lot of labeled, green, social, and sustainability bond issuance. I think it was around 850 billion or 900 billion globally. And so, it's certainly happening in a lot of places, but it's certainly stalling on the corporate side. And then maybe and then US municipal bond issuance in the labeled market has kind of stalled too.
Very interesting.
Just wanted to note that.
Yeah, very interesting. I mean, on that point, like Florian or Estelle, like in the world of academia, like since I guess the start of 2025, have you guys seen maybe a shift in trends based on current administration policies, and how it's impacted like the use of ESG metrics or how companies have been following along this path?
I can, just say from like the reporting side, so I teach a sustainability reporting class. Here is one of the newly developed course of by the accounting department. So we talk about that question a lot in our class. In the current year, I feel like my teaching material has been constantly changing because every class there's an update. So I think there's definitely rollback in terms of the ESG regulation in that sense. I think research has to catch up a little point. It's just a very fast moving things we are looking at right now. It seems that everything's going back to voluntary. Last year we thought everything's going to be mandatory. This year, companies are really jumping into this. But now, based on different rollback, I think we're kind of back to, yeah.
Very interesting. Florian, anything to add? Or?
Yes, but ask me the next question.
Yeah. All right. Sounds good. Lauren, we'll start with your second question. You've emphasized the importance of material ESG issues versus immaterial ones. In our project, we use SASB to filter for materiality. Do you think enough studies make this distinction when testing for alpha or premiums?
This is a great question. And first of all, I really enjoyed actually your presentation because the way you interpreted the coefficients, I think there are probably 5,000-6,000 studies written about this correlation between financial performance and ESG performance. And there are not many that actually present it the way you do. So that was actually very, I would say, the academic way of presenting it. So I'm actually I was really happy. I was really smiling there. So great. The problem with thanks Andy for the watching a little bit. So the problem now with SASB is that it was actually the standard came into play in 2016, right? So in these working groups for SASB, a lot of people came together and looked actually at also not only what industry leaders said, but also what academic research has determined what would have a potential impact on profit or on the stock market. Now, if you use then this in a study prior to 2016, and I don't know when you started, right? Then this is a problem because you have a forward-looking bias and you might find a correlation, but it's completely artificial, right? And I think this is a big problem in academic research when we use SASB. We can only use it after that time for this kind of studies. The other thing is that with SASB, and now we're also talking about regulation, right? What is surprising, it's sort of one of the core tenets of ESG disclosure. Basically, what most of the frameworks or what most of the people say is, you as a company, tell me what industry you're operating in, and I tell you what are the indicators that I have to disclose, you have to disclose, or what indicators are financial material. And SASB is really doing that. When I now go outside and talk to CEOs, CSOs, or chief sustainability officers of large companies, they always tell me I'm special. I don't really fit in those grids, right? And you've heard that probably a lot in your life, this word I'm special, and nothing good is following. But so I really dismissed it, right? And thought, okay, everyone thinks he's special, right? So, okay, that's it. But then actually I started doing a little bit of research and looking into what companies actually disclose. And I saw actually more and more patterns that they actually really, where companies are actually really hard to fit into this really strong materiality matrices of certain industries. So I do think there is a lot of things we don't know yet, and we have to do a lot more research on actually does it actually make sense to have such a strict separation between what is financial material and what is financial immaterial, right? And yeah, I think this is what's surprising actually for a lot of regulation in Europe in particular. I'm just coming back from Europe 2 days ago, and I talked a lot to regulators because actually also, through my research that we were talking about, so those ESG ratings, I got very much involved. And I'm more and more getting also involved in ESG disclosure. And here we do a lot of, from this perspective, that we have to, that basically everything depends on the industry, right? We actually come up with more and more research. And it's interesting that we see now that this starts actually getting criticized. And that's why there's also sort of rollback. So there's a sort of, in Europe, that's what's happening at the moment. So there's also the rollback from Trump, basically, political, but there's also the rollback because actually academic research starts keep catching up a little bit with the regulation and starts criticizing it. And interestingly enough, in Europe, they're actually willing to talk about that, and then they're willing to change it. A major example of this is the Sustainable Finance Disclosure Regulation. That's also a lot of reporting but on the fund level, on the mutual fund level. And they're clearly, they understood the message and they're completely changing it within the next couple of months.
Very interesting. Thank you for that. I'll ask the next question for Robert. One major hurdle we faced in our research was the lack of standardization in ESG data, especially in the equity markets. How do you navigate fragmented ESG data when trying to generate conviction in investment decisions?
Yeah, that is a huge challenge for sure. One we face, like all investors face, whether you're investing in a company's equity or bonds. And we generally invest in companies that are in the S&P 500, so mid to large cap companies that are debt issuers, and they're U.S. based. So it's a big challenge. Like you talked about SASB, Florian talked about SASB. I think they made a real important and constructive contribution to the ESG sustainable investing space by kind of promoting the use of the term materiality. When we first started looking at a company's, we could debate this. So when we first started looking at a company's sustainability profile, when we first launched our sustainable bond strategies in 2011, we'd look at a company sustainability report. I would, as an analyst who's new to ESG research, and look at it and think, wow, yeah, these employees are really doing a great job in the community, volunteering. They have great pictures in the corporate sustainability report, and they're also donating 10% of profits to charitable organizations. And I think, wow, that's really great. It says something about the company. And because of that, it influenced my, sustainability opinion of that company. Over the years, we all started to realize that that is not a material, financial driver. Although it's important and you want to see employees volunteer, and it's great that companies are donating. It doesn't, that part of the disclosure doesn't speak to how a company is managing a material risk. That's at a high level. So specific to your question, what we try to do is our corporate ESG process is essentially three legs of a stool. We have a quantitative model that looks at ratings from MSCI and Sustainalytics, which are, they used to have positive correlation. Now I think they're negatively correlated. Yeah. And so that's not so good, but it's, it's part of our model. And then we also try to source company reported information from Bloomberg using Bloomberg Terminal. But to your point, there's just not a lot of standardized disclosure across all companies and sectors, despite all the great work that SASB has done. So we still have to rely on MSCI and Sustainalytics. So that's one leg of the stool, is the quantitative model. Another leg of the stool is that our analysts are doing, looking at companies' corporate sustainability reporting, doing the qualitative research, kind of looking at whether, like Estelle mentioned, if they have a GHG reduction target, is it aligned with SBTI or not? What progress are they making? And then the third leg of the stool is that we are having direct conversations with companies about their sustainability practices and performance. So we have a chance to talk to their chief sustainability officer, and financial people, other department heads who are managing these risks. Takeaways from these conversations can influence an analyst's opinion of a company's performance. So each leg of the stool comes together into a sustainability rating, and that rating can influence the analyst's overall recommendation of the company. So we don't want to rely just on the data or the scores, because there is other great information to consider.
Do you want to add?
Yeah, I just want to give some appreciation actually how hard it is to measure ESG. And I think one example here is that, for example, DI, right? It's very qualitative. How do you measure actually discrimination? Who has actually been to Sweden? Can you raise your hand if you have been to Sweden? Yeah. Do you think it's a very safe country? Would you say that? Probably yeah, you felt safe. Yeah. You're not a woman, but also has a woman been to Sweden? So Sweden actually is in sexual harassment cases per capita number 3 in the world. Number 3. When you're there, most of the women say that they're very safe. There's also a lot of research written on actually that women feel empowered to speak up and actually bring cases are brought to court when there's sexual harassment. So it means there's a huge transparency around it. But that's why they end up in those statistics very high up. And they also have a very broad definition of what actually rape and sexual harassment is. So now actually, how do you really then interpret that, right? Is a rise in sexual harassment cases now in a company, is it a good thing or a bad thing? Uber didn't have any sexual harassment cases until it became public and they fired their CEO. At that moment, they would have deserved a better ESG rating, but now they have a lot of sexual harassment cases because they started doing something. So putting this data into context, and this is true with every dimension on those ESG ratings, is really, really complicated. That's why we need those ESG raters, because when firms actually disclose data, you have to interpret it, right? You have to put this in context. Same for CO2 emissions, for net zero targets. Do actually companies follow really through when they set a net zero target? That's why we need those ESG raters, but it's really hard to tell from the outside. And that's why you might actually sometimes end up with a different or very low correlations. In particular, when they also measure different things, because MSCI and Sustainalytics, they say that they measure different things.
Very interesting. Yeah, thank you, Robert and Florian, for that. Last question before we ask some more general questions. This one's for Estelle. Given your work on voluntary disclosure and market pricing, do you believe markets are efficient enough to consistently price in ESG risks, or is there room for inefficiencies and thus potential returns?
Okay, so that's a hard question about market efficiency. I can speak to you, based on the work I have done. So again, I'm referring back to the paper I just talked about, the evaluation of a greenhouse gas emission. So when we work on that project, one conclusion we draw is actually we believe market is partially efficient. So one unique feature we did in that project was trying to understand how the market value the level of greenhouse gas emission level for companies that did not disclose what the level is. You may wonder, okay, if they did not disclose it, how do you know what their GHG level is, and then how would you value that, right? So for those non-disclosures, we actually came up with a prediction model to estimate what their greenhouse gas emission is based on what industry they are in, how old their fixed assets are, based on the firm characteristics they have, and then we were able to estimate the level of greenhouse gas emission for those non-disclosing firms, and we actually showed that the market actually assigned a negative weight to those estimated greenhouse gas emission as well. So so basically the bottom line here is that it seems that the market is reading between lines, even for company that failed or they choose not to disclose greenhouse gas emission voluntarily, investor kind of figured it out, and then they actually penalize companies with high greenhouse gas emissions. So that's kind of the first part. And then about the premium, that's kind of a more like a finance question. That do we have the ESG premium? I think possibly, I don't have a definite answer here. If I have a factor, I think that's going to carry a risk premium. I'm going to write a paper on that, and I'm probably will trade on that. So I don't have a very clear determinant for that. But I think based on what we have seen in both accounting and the finance literature, I think the answer is yes. So a couple of recent papers published in finance, they show that climate risk can potentially carry a risk premium. So the argument there is that if you are a company with high climate risk, investors demand higher expected returns and to compensate for the risk. As a result, those papers actually show that companies with high climate risk have high realized returns. That's one thing. But on the contrary, there are also academic papers showing a completely opposite thing. They show that company with high climate risk, their realized returns are much lower. The price actually go down. So I think the results are super mixed. You guys talk about this as well. I don't think the literature actually provide a solution for the conundrum. We don't really know what's going on there. We can speculate what can the possible reason for that. But yeah, I don't think the conclusion is that clear at this point.
Very interesting
Yeah.
to hear.
Yeah,
What you wanna add?
I absolutely agree. And I think the big problem is here that we run 6, 7, 8,000 studies that find a correlation between ESG performance and return. But yet we have not really conclusively said why that is. Because you might find a positive correlation, right? Let's assume we do. But why is it that this happens? Is it mispricing? So is the fact that I use ESG information, does that make me discover some mispriced stocks and then I buy them, and so then the return goes up and I make a better, higher return in my portfolio? Or is it because everyone else wants to hold the stocks and wants to buy those stocks? And so if I own a stock that is high ESG, then other people buy it, then the price goes up, and then I see my return going up. It's more like a self-fulfilling prophecy in that point, right? So we don't know that. We don't have an answer to that. And that is actually a little bit unfortunate to really not have an answer to that. Yeah, I want to leave this here.
Yeah,
And
definitely.
I think so you're actually very, you can be very proud because you have one of the biggest critiques and really someone that really started the critique about this in the literature, and it's Andy King.
Thank you, Andy.
You're absolutely welcome.
So yeah, why don't we start with the more general questions? Start with Robert, and then we can come down this way, and then maybe go back the other way for the next question, so everyone has a chance to answer first or second. So Robert, us four, we're students and researchers trying to bridge theory and practice. What advice do you give to ensure that empirical ESG research remains rigorous, but also relevant for the investment community?
It's a tough one. I do think all the studies that have been discussed today, that you mentioned, Estelle and Florian, I think they can be very helpful for the investment community to kind of better understand like areas of research and inquiry. I mean, I think what can be challenging, like, as an investor on a day-to-day basis, you're kind of focused on what's going on, and you have, I want to talk to this company next week and you're doing your in-depth investment research and ESG research on that company, you kind of get caught up in the day-to-day work. So it is helpful that the academic papers are there and they do really definitely help direct thinking. We've definitely relied on them to a number of degree to like educate ourselves on key trends and takeaways. If that makes sense.
Thank you very much for that. Warren, do you want to add, or Estelle, do you want to add?
I think from my perspective, I think it's super important to talk to people like Rob, talk to the practitioners that's out there, asset managers, ESG analysts. I think they're the people who make real decision in the real world. So if you have some ideas, just talk to them, and then hopefully they can shed some light, tell you whether this research questions is not just academically interesting, but hopefully, useful in the practice as well. Sometimes I think they do a great job in terms of doing a reality check for the findings I got. In my world, in theory, we had a PwC partner in my class last week, right? So I actually asked him, I said, I have a paper looking at for companies that located in areas that's prone to extreme weather events, wildfire, hurricane. I actually find that the audit fee for those companies are higher. I asked him, do you think this makes sense? What do you think? And then he actually explained exactly like how they price the fees, right? And he actually I really like the answer he provided to me because it one support the finding I got. And he actually saying that the one company are located in some places, locations that prone to extreme weather events. They say they spend more time to plan, to engage with the client, they do more work to assess the risks they have. So potentially they spend more time, therefore it's very possible the fees are higher. So I think it's nice, to get that. And during the review process, we tend to get this question a lot. Have you talked to your real auditors because you're analyzing their fees? Do they agree what you have found here? I think it's great to talk to them in that sense.
Definitely. So we just checked the time. We're a little slow on time. So we're just going to open up to Q&A right now. So if anyone in the audience has any questions for our amazing panelists, please let us know. Raise your hands. Yes.
How exactly are we defining ESG? Say these companies follow ESG. Using SASB standards, we're using Moody's, we're using ISSB.
Great question, Bob. I really like that. So I think it's for me, the problem with ESG, actually, I call it the original sin of ESG. Why do I call it original sin of ESG? Because I had to give a talk in Italy and they're all Catholic, so I thought it was funny. So I think the problem with ESG is that we attach a lot of meaning to it. We attach saving the world, we attach higher returns, lower returns, mitigating risk, impact, right? But for me, actually, ESG is generally just a data term. It just categorizes data, environment, social, and governance data. And then there are a lot of stakeholders and in this ESG space, and they all have their own definition of ESG, what it means. What is part of the environmental dimension, and how do we look at it? Do we look at it from an impact perspective or from a risk perspective? Do we look at it from a financial materiality perspective, like SASB? I think this is really then how, in my opinion, how we should see the ESG data term. And I think what is really confusing in this, especially when you start looking at all this data, is that there is no truth, right? There is not a single definition of ESG. It will never exist. I do a lot of, when I teach ESG ratings, I let actually my students come up with a ESG rating. And so far, I've probably taught that 20 times. And so far with each 10 groups, at least in my class, and I think there's never been the same ESG rating. And this is true for the whole space. I think there's just not, we cannot have one single definition. So what we need actually is more transparency and more understanding of what every actor aims to measure, right? This is the most important. We have to be upfront about it. When we say we want to measure risks and opportunities, then we also measure risks and opportunities. We measure impact, then we measure impact. And you're thinking this is obvious what I say, but it is actually not. So when we actually set out to do our big study with 6 different ESG raters 7 years ago, we got 6 different data sets. And 4 of them, in really large companies, we asked, do you have a methodology document? And they said, no, we don't have that. And it's like, maybe an internal document, right? It doesn't have to be organized, doesn't have to be beautiful, just need to understand what's in the data. They said, no, we don't have that. So this transparency is actually the real, I think, the key thing here.
Thank you for that. Yes.
I'll just add on briefly from like the investment management perspective. I totally agree with the transparency point, Florian. And I think that's something that the asset management industry in the US really got itself into some trouble because of the lack of transparency. Like because of the real popularity in sustainable investing over the last 5 or 10 years, you saw a lot of investment managers, slap ESG or impact onto funds and then not really well define what those funds were seeking to achieve. And I think because of that, and because of the vagueness of the ESG term, it drew attention from, certain politicians in the US. And some of that I think is really warranted because to your point, like you need to have it, you just like the ESG rating providers need to have transparency and not just have their ESG process be kind of like a black box without any clarity. Asset managers need to do the same thing. And so you had certain people think that an ESG fund was really about divesting from the oil and gas sector. And maybe some funds were doing that. And because of that, certain politicians from certain states in the US who represent, economies that are based on oil and gas took real offense to what some of these funds were doing. So some of that scrutiny, I think, is probably somewhat warranted. So I think what's going on right now and what we certainly have done is just as in the investment space is to be really clear about what ESG means to you as an investor and what you're seeking to use it for. And for us, we have long said that integrating these factors tells us more about the companies we're investing in and the risks that they should be managing. And that we're doing it to manage and mitigate investment risk. That's the key focus.
Thank you, guys. We'll take a call from, or not call, but a question from you.
So I was wondering kind of what you said at the end there. We're learning about like information asymmetry, like principal agent problems. So as someone like behind the scenes managing, when you're thinking about shareholder and like giving them what they need or what they want, like providing for them and that shareholder value, do you think when they say that they want a company with good ESG, they actually want transparency and like the truth and what the actual ratings are? Or do they want it to be a good rating in the sense that they like can for their own reputation at stake? And how do you like balance that with transparency and what they actually want?
In terms of like the clients that we work with or
Yeah.
like the client? Yeah, that's a great question. I think that they basically want us to, they want to know that we're paying attention to these risks and looking at different forms of research to help uncover those risks. I think they certainly understand, like we were saying, that it's not perfect. So we tried to provide some reporting on what we're looking at and our conclusions from our ESG research, and we joke sometimes that we call it like ESG storytelling. Like, and that's been like an important part of the sustainable investing space. Like if you have Pepsi or Caterpillar or IBM in a sustainable portfolio, you have to provide some justification for why it's in there. And we've definitely gotten pushback on Pepsi. Well, they're very focused on, sugary drinks. Why is it in there? So you want to go back to them and explain, well, they're doing all this other great work to manage the overall ESG risk profile for their business. So if that makes sense, yeah.
You want to add? Okay. Any other questions? Yes, in the back.
Yeah, my question was, in order to improve, ESG ratings, you said that you need more transparency. But for a firm to increase transparency, that may lead to like negative ratings towards your company, negative reputation. What would incentivize a company to do that besides their risk factor? Because that could lead, if they don't truly have like a motive for ESG things.
I think that two, do you mind if I, yeah? There are two ways. There's first of all, clearly regulation. You have that in Europe, for example. There's a lot of pressure on companies to report. And even in the US, you see that companies report more and more through traditional channels like 10Ks, right? 10Ks are this mandatory filings with the SEC when you're listed on a stock market. So you see that. And the other one is really pressure from stakeholders. So a lot of investors nowadays, we see that in earnings calls. They speak about, they ask about ESG. And so then the company will act on this and will start actually putting, if they have the feeling that this resonates or this is what investors want, then they will start measuring it and putting that out. Yeah, I think those are basically the two main channels. But we also shouldn't forget, I mean, everything is very much in the beginning. Financial accounting has been around for what, 100 years? And in the beginning, when you read actually old discussions about financial accounting, they actually said also, oh, regulatory overreach. Why do we need all this data, right? Why do we have to collect this? Investors are like, don't care and all this. And that I'm not saying that everything in ESG is going perfectly at all, right? I'm not really saying that, but we're still figuring out. It's very recent that we actually start looking at this. And we shouldn't forget that it's a very new field.
All right. Well, oh yes, you want to follow up?
I just want, so what are some of the ways that like people are planning on getting all the firms to become more transparent? Besides, what are some policies or things going on currently?
I think the number one way at the moment is really investors talking about it, right, with companies and then putting it out. We had 3 years ago, there were 6,000 companies reporting CO2 emissions, scope 1 emissions. Now we have 24,000 companies worldwide. It's that steep, right? The growth. It's insane, really, when you look at the data, how many companies put this this out. But again, also disclosure doesn't mean perfect quality. So we have to learn, how do we actually account for CO2 emissions? Really hard. There's this greenhouse gas protocol, which is an accounting standard that everyone follows, but there's so many little detailed questions that you have to actually figure out. And so we did actually a study on how good the quality is. And some of those companies that disclose CO2 emissions, they actually ask auditors, like in financial accounting, assurers, as we call them, to look at how good the number is, if they respected the methodology, and to do some auditing and then also in the factories. And we saw the moment when companies that voluntarily disclose CO2 emissions, they also then voluntarily asks auditors to come in. The CO2 emission after that go up by 13.5%. So even though they think that they are the good players, right? Because you wouldn't invite the police at home if you have drugs. You only invite them at home when you don't have anything, right? Same with assurers. You think you're clean. And then the CO2 emissions go up by 13.5%. So that means there's a huge learning effect. And so I started talking to the big four, the auditing firms, because they do also the CO2 auditing. And I asked 3 out of the 4 what was going on. Why 3? Because no one wanted to speak on the record. And so now you can't identify them. And they literally said, funnily enough, we go in and ask what is actually happening and look at the methodology. And first of all, in most companies, the list of factories that they own is not even complete. Because the sustainability department is very different from the financial department. And so first thing that they say, oh, let's go to the finance department in a company and ask actually for a complete list of the factories that you own. and so on, right? And then there's these different interpretations of the greenhouse gas standard. And there's so many different moving parts, right? We're figuring it out, we're learning it, right? And this capacity, right, of to create an inventory for CO2 emissions, it has to be created within the companies. And this is like what's happening at the moment. So we're very much there. We're really in the beginning of learning how to do the accounting for all this. Yet we already wanted to be in the discussion. When we have discussion, we actually want to look at what's actually the impact on financial return, right? Even though I'd argue those is great that you did those study, right? But we still have to figure out a lot of things before.
Okay. Well, thank you very much. Please join me in a round of applause for our panel.